This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. I want to talk about charts today. Charts that you can't see, but I'm going to do my level-headed best to describe them. The first chart, courtesy of the New York City Taxi and Limousine Commission. Oh, you're already bored? You could care less about the New York City Taxi and Limousine Commission? Stay with me for a second. I'll try and give you some little bit of insight that you're probably going to go, aha, that's very cool. At least I hope. The chart, how the price of a New York City taxi medallion has changed. Pray tell, what is a taxi medallion? Apparently, in the taxi industry, in many major cities, they sell you a little label or medallion, so to speak, that sticks to your car. There's a limited number of these medallions, and they're worth a lot of money because supply and demand, artificially created by the government. Now, back in the time period of 1995 or so, a New York City taxi medallion was about $200,000 US. It got up to about $250,000 in 2005. It got up to about $600,000 in 2010. And it got up to about 1.2 million, even higher in 2013 or 14. But since then, of course, Uber, Lyft, Grab, taxi cab services, it's crashed. It's crashed right back down to the levels that it was at in 1995. The classic bubble up, bubble down. I mean, it seemed like a great deal, right? You get one of these medallions, they go up in value, you can mortgage your house against it, whatever. And nobody was imagining that a telephone would allow everyone else to be a driver and thus kill the taxi cab industry and the medallion. Now, the chart that I'm looking at is really, really interesting because it's a 60-day moving average plotted over medallion sales over this time period from 1995 until current. So that moving average slopes up to the right and then comes basically straight down within a year or two, right back to the 1995 level. Perhaps we'll go a lot lower. Now, what's so cool about that? You did not have to know a damn thing about taxi cab medallions, a damn thing about the taxi cab industry, nothing about New York City cabs at all. All you had to do was take the data and apply a moving average and follow it. Now, of course, you don't get in at the bottom and you don't get out at the top. There's no perfection of timing the bottom and the top. That's fool's gold. It doesn't exist. If you're trying to do that in your market investments, you're an idiot. You're a fool. You're a moron. You don't time the top. But for these guys and ladies that own these medallions, the simple moving average was telling you that there was a big damn problem. You don't know what a simple moving average is? You don't understand the concept of taking a data series and applying a moving average to that data series to have a sense of which way the trend is moving? That doesn't ring a bell with you yet? You've not figured that out yet? You just trust that the United States Federal Reserve and the United States government will take care of you with passive investments and negative interest rates, and it will all work out fine by the time you retire? Is that what you're waiting for? No. That's not what you are waiting for. Come on. If you don't yet have an idea of what this trend-following mindset is, now is the time. Let me give a few links, a little self-promotion, free self-promotion. You're not even going to have to pay me $1. But let me send you to a few links. Trendfollowing.com/zero sum. trendfollowing.com/events, trendfollowing.com/markets, trendfollowing.com/charts, trendfollowing.com/resources. That's what, 5 or 6 links that will keep you busy for days. Oh, you don't want to be busy for days. You want the instant piece of advice, the hot tip that some guy in some podcast tells you exactly what to do, that you just trust him, and that's all you need? Do I really seem like that type of person? I enjoy giving people great insights. It's then up to you to go do the homework. It's up to you to do the reading. It's up to you to turn your freaking brain on and stop being a lemming. Now, of course, there are plenty of extremely competent, extremely smart people, much brighter than myself, listening to this podcast. So everyone is in their place, in their state of mind, and they know what part of my message is for them or not for them. Do you know the physicist Richard Feynman? He's been on this podcast. I mean, he's been dead for a long time, but I've still had him on the podcast because he's freaking brilliant. Do you know about the Feynman technique of learning? It goes like this. Step 1, pick and study a topic. Step 2, explain the topic to someone like a child who is unfamiliar with the topic. Step 3, identify any gaps in your understanding. Step 4, review and simplify. That's the Feynman technique for learning. Quite simple. He is one of the guys that worked on the Manhattan Project. He is a brilliant physicist. Why is it so simple? Why does he keep it simple? Why is it not more complicated? Why is it not more complicated on the New York City taxi medallions that we don't have something better than a moving average? I mean, it is complicated. It is a wide swath of data from many buyers and sellers. We don't know their motivations. We don't know why they're selling. We don't know what they understand about value. Who gives a shit what they understand about value? Who gives a shit about what we understand about value? Value is not the point. The point is follow the price. That's what the moving average gives you. It gives you a chance to ride something up and to ride something down. It gives you a chance to preserve yourself, to hang in the game, to not lose your shirt. And then when it takes off, whatever market it might be, you're ready. Ready, willing, and able to play the game. Now, let me go into a specific trend following example. I'm not going to name this trader because I don't want to. I mean, I like him. He's a really interesting guy. But his name is not that important. Not that important for this example. He's a very important guy. I really respect his work. But I want to use his work to tell a story. I want to use his work to educate, to show how something like trend following can work and how it can surprise, and how in August of 2019, it just surprised again. Now, the track record that I'm looking at is continuous from 1999 to 2019, 20 years. 20 years every month. That's a pretty interesting data set. I mean, it's not actually every month because the first couple years, there were a few missing months of not trading. But other than that, it is a very complete, rock-solid data set from 2002 to 2019, 17 years. Now, if you're going to trade for 17 years and still be alive and still make money, there might be something worth investigating there, especially if that trading strategy is not a passive index, is not buy and hold, is not the exact same S&P return that everyone else has. This kind of data is cool. This kind of data is unique. This is the kind of data that if you're a nerd, if you're a geek, if you're a data analyst, this is the kind of stuff that wakes you up and says, whoa, what the fuck have we got here? This is different. This is not the same old shit. what is this guy doing to generate this money for 20 years? So let's get right to his big month. Actually, it's a big 3 months because he made about 7% in June. He made about 9% in July, and he made about 30% in August. 30% up for the month of August. Is that scaring you? That's too much profit in a month? That seems high risk, high reward? Not exactly. What that 30% says is that markets moved a lot for the month, and he caught that movement. That's what it says. Now, if I look back to earlier in the year, where he lost 19% in 1 month, that minus 19% means he took a lot of positions that did not go his way. And when they didn't go his way, he got out, saved his skin, saved his capital, and waited until August of 2019 for the big trends. Hold on, Mike, are you actually saying he could predict and wait for August 2019 to happen, where he makes 30% in 1 month? He knew that was going to happen? No, he did not know that was going to happen. But he had a trading strategy that was ready for when it did happen. Now we're talking diverse markets here. Interest rates, currencies, softs, metals, livestock, energy, grains, stock indices. We're talking huge gains on interest rates. We're talking some down moves on stock indices. But you average it together into the big soup. And that's where you get the big number of the plus 30%. Because this guy doesn't have a bias that says I must make money in interest rates. He doesn't care. Or a bias that says I must make it in metals or softs or ags or energies. He doesn't care. He's sitting there with a poker face saying, I'm ready for whatever momentum you bring me. I'm going to trade it. This is the trend following mindset. I don't know what's going to happen. I'm ready. If a momentum move happens, I'm going to get on board. And if it goes my way over the course of a month, I'll end up with a plus 30%. If I get on board and it doesn't go my way and I got to get out, I take a small loss. I get back on, I take another small loss. Next thing you know, I've lost 19% for the month. Now, this might sound a little unusual if you are uninitiated to the trend following mindset. Such big moves. Did you see the comment from Michael Burry in the last week? Michael Burry, the autistic guy, the guy with Asperger's, featured in The Big Short, who came out and said, now this is after in The Big Short where he said subprime was going to go to hell, and I think he made $2.5 billion, I believe. Not a trend following guy, just a wildly smart guy who figured out that subprime would collapse. Well, he's out again with more views on things to come in the future. And he points out that this land of passive indexing, all the rage for the last 10 years, is not necessarily the safest thing in the world. Because if you take a stock, and these exist in the Russell Index, these exist in the S&P, if you take an individual stock that really doesn't trade that much, 100 million, 200 million in a day, something relatively small, but inside the indexes then come and trade trillions of dollars on top of that stock. This stock that has relatively small movement, not huge liquidity. It makes up part of the index. And then all these huge piles of money that trade only indexes throw trillions of dollars at these stocks that make up the index. Burry points out this has the potential to do the same negative downside move that we saw with subprime. Now, am I betting on his logic? No, I'm not Michael Burry. I don't know about that. I don't have his intelligence. And most likely, the best trend following traders do not have Michael Burry's intelligence either. But we don't have to. All we have to do is to be ready with a system and follow along. Follow along the momentum, however it might unfold, with your stop loss. Now, I bring up Burry because, let's face it, that's interesting. I'm talking about one trend following trader who just made 29% in the month of August 2019. Michael Burry is saying that passive indexing has gone crazy and will eventually drop. He sees it dropping just like subprime. I don't say all this to scare anybody. I don't say all this to make any kind of a prediction. I'm challenging you to figure out how a particular trend following trader made 29% in August of 2019. I'm challenging you to understand a little bit more about why Michael Burry is perhaps afraid. I'm challenging you to think about why Alan Greenspan, who I think is 117 years old, just came out and said the U.S. will go negative interest rates soon enough. Now, I know everything looks swimmingly fine right now. Stock market's generally been up for a decade. But do you really trust the system to take care of you? Do you really trust that it will tuck you in at night and give you a kiss on the cheek and that everything will be okay? Do you ever think about the possibility that the Dow could drop 50% or 60% or 70% and take those healthy buy and hold returns that you currently have and reduce them to the year 2000 level returns? Do you ever think about that? Maybe you should. These are all just good questions to ponder. I want to get your curiosity up and moving. And you're welcome to question me too. I don't think I've said anything today that is some grand pronouncement or prediction. This is the type of mindset you find across my trend following guest on this show. It's the type of mindset you find in my books. So I've given you a homework assignment. Get out there right now. And first and foremost, find out how somebody made 29% in August of 2019. Because the last that I heard, and this happens about every 5 years, every 10 years, the last that I heard, trend following was dead. And it did not work anymore. Now that's interesting, isn't it? It sure as hell looks like it still works to me. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.